Welcome everyone to the Aria Commercial Coffee Series. And today we've got a very exciting lineup. But first, I want to thank Jazz and Vanessa for doing all the stuff on the back end, as always, and Amy Kong and Hope for making this all possible and supporting the commercial committee. We've got some really exciting things going on in the commercial committee, starting with a white paper, our second one that we're about to send out to the members, sponsored by Caldwell Banker Commercial. And Jane, she's our member that's really been helping with that. So thank you, Jane, and thank you, Caldwell Banker Commercial, for providing that great information that we share to our members. We're also doing, we're continuing the commercial coffee series, and today we have a special networking edition where all of you that have signed on are going to be able to talk to each other and network with each other in lieu of having, in-person conferences, which we all miss so very much. Mm-hmm. So with that, today we're going to discuss commercial financing and how you go about, thinking about what to do with financing a commercial deal. And we have a very special guest, Zahra Jafri. Zahra, welcome. Zahra has had so much experience in this space, and she's really a rock star. I want to tell you a little bit about her. She's the founder and visionary of Lynx Mortgage Bank. She started her own business in 1989. And she sharpened her skills as an entrepreneur and sought to learn all she could in New York real estate and the mortgage industry. She's the head of, she serves as the past president of the New York Association of Mortgage Brokers, as well as the president of the Empire State Mortgage Bankers Association. And she currently serves as the vice president of the Mortgage Bankers Association. So welcome, Zahra. Thanks for joining Aria Commercial today.
Thank you for having me. Hello, everybody. Hope everybody's doing well.
Yes, we're all so excited to have you on and to talk a little bit more about financing commercial real estate. But before we get into all of that, I'd like to find out a little bit from you how you got started in this business, especially as a woman. You don't see that many women back when you started, even today, but having the courage to do that. We've really been trying to push women leadership under Amy. So it would be really interesting to hear how you got started in the mortgage banking,
So
space.
My experience is pretty interesting. I completed my studies. Actually, I'm a family therapist by trade. So I got married and moved to New York, and my husband had a law firm, and I, didn't really know what I wanted to be when I grew up. I was married, but still trying to figure it all out. So I would go into his office, answering the phones, just trying to figure out where I was going to, do my courses and training in my field. And his clients would call and say, we need a mortgage. I thought, oh, really? You need a mortgage? And attorneys automatically receive a mortgage broker registration upon their being admitted to the bar. So I thought, well, while I'm waiting to figure out what I'm going to do, I can just help these people find a mortgage. Mm-hmm. I was always very entrepreneurial, always just trying to figure out ways to start a business, do a business. Before I came to New York, I was trading commodities. That's where I got the name Lynx Equities, because I wanted to have, Canadian name.
Right.
Canadian Bobcat. Anyway, so my clients would call, his clients would call, and I started just placing their loans as a broker. There was 3 companies: Citibank, Greenpoint, and Shearson Lehman. Mm-hmm. And that's where I started, and it just started spreading from there. And I thought I really liked this, so I started just walking real estate office to real estate office, knocking on their doors and asking them if they would give me their mortgage business. And many people slammed the door in my face, and many men asked me very inappropriate things. And
yes, we've all been there.
But it just never fazed me. The fact that I was a woman and doing this, it was just, this is what I wanted to do. And after a year, I just put the registration into my own name. And I was a broker from 1990 until 2003, when I applied for the banking license. And in 2004, we were approved, and the rest is history.
Well,
And 3 years ago,
sorry, go ahead.
we opened the commercial division, and we
Mhm.
broker commercial loans. So the mortgage banking is all residential, and the commercial end is all brokered.
Right, right. Well, that's really amazing. And the fact that you serve on all these boards and committees, I know it takes a lot of time and a lot of dedication, and it's a way of giving back. So that's also
Well,
very
people don't
impressive.
ask me for coffee anymore.
Well,
Even though I never mind.
we're at the commercial coffee. So today I hope you have yours, and I hope everyone, sitting in their home offices also has their coffee with them. But let's get into the heart of this. I want to really help, the people that are listening. I want to help them examine the capital stacks, and maybe, Zahra, you could explain to people when one would use debt versus equity.
So that's all going to depend on each deal is unique in itself, number one, and it's really just going to depend on, the leverage that's being offered and available. And that's, if somebody has a lot of equity, then they're not going to need as much mortgage money. So, and that's not going to be determined until we review everything and see what the deal has on the table. So, and there's no real right answer when to use more debt versus equity until you analyze each specific transaction.
Okay.
And
Okay.
that's,
Well,
the benefit of us, where we would look at
Right,
everything and
help.
say, this is what, this is where your strengths are, this is where your weaknesses are, with this loan can go conventionally. If people need the money quicker, you might want to take the bridge option. So.
Okay, well, can you go into that a little bit more? Like, what's the difference between a conventional debt versus private debt, bridge financing? Can you just explain that to everybody?
Conventional loan is essentially fixed rate product. It is a bank product, Fannie Freddie. The terms are usually a little bit better. The rates are usually a little bit better. And you use a CMBS type of a loan on, industrial loan or any type of financing that has a strong financial backing. Debt loans, debt equity or bridge is used, if there's a little more financing that needs to be established, typically the interest rate's higher. If people need money really quick, conventional loans will take 60 days, 90 days. Debt, you can wrap it up in a couple of weeks.
Okay.
Depending on where we go with it. But, the saying is, if the deal has a lot of hair, then you go for a bridge loan, season your finances, and then go back and apply for a conventional loan, which would have better terms and better interest rate.
Okay, so in terms of, you mentioned the CMBS loan, which I deal a lot with because I do a lot of hospitality products. Can you kind of go through, the different asset classes, like what types of loans are used in hospitality versus retail versus industrial? We can go through them one by one. What do you see more of being used?
So for office and hotel, we see a lot more conventional money. Multifamily is a lot more agency financing. A lot of times, like, we get the specifics on every deal, whether it's a hotel, whether it's industrial, whether it's multifamily or, office space, and then we have to place it. But to me, all of the four products that I just mentioned, it could each transaction could go conventionally or need bridge financing. It's going to depend on the purchasers and the investors and how much they have invested in the transaction. So,
Okay.
to go through it, dissect it, I wouldn't really, sometimes you might have a hotel hospitality transaction where you have to get bridge and equity.
Right.
And then wait a year, get your project in
refinance.
place, and then refinance into conventional.
Yeah.
I mean, what's been your experience on it?
My experience is exactly what yours is, and just learning, when I came into the space as really a broker on the real estate side, learning all these different terms was really helpful for me, and figuring out what the difference is. I mean, I see more CMBS than anything else in hospitality, and that just hasn't been happening lately since COVID started. The hospitality financing has really dried up. Everyone's looking for private equity options. And the bridge financing, the rates, just so everyone else knows, like for hospitality, they're much higher than the multifamily product that
Right.
I work on, because it's considered more risky. So
There's no
that's,
cash flow with hospitality at all right now.
well,
So,
especially today, but it's changing because, we do, I've been doing a lot of research, and, I host another show outside of this, not for ARIA, just on hospitality. And, the hospitality market is really picking up a lot. But that's another conversation for another day. But it's, I see the ADRs, I see the occupancy going up. And I think there's a lot of corporate travel that's slowly coming back as well, in addition to the pent up leisure demand travel. So I think the financing is going to follow once the numbers are there to support it. So I want to talk a little bit about the criteria. We've touched on it a little bit with the hospitality, but when it comes to, the profile or the resume of the borrower, what kind of things are you looking for from a domestic borrower versus an international borrower? Because I mean, I'm sure all of you, also have international clients that ask, like, how do I buy something in the United States? I've got all these assets in, another country in Asia, but I want to buy in the US. And, are there loans available to me here? So
I think
I want everyone to hear it from the expert.
I think the biggest thing that we look upon in that scenario would be liquidity. What is the investor's liquidity? What is their reserve requirement? Pre-pandemic, we'd look for 6 months reserves. Now, I mean, some of our lenders are telling me 12 to 24 months reserves. What is the establishments, what's the history of their business? The personal financial statement has to be significantly stronger than it would have been, because, it's all about skin in the game, and what is that person's ability to be able to hold on to the project and or make payments on any type of loan should we experience anything like what the pandemic, like we just did. What's the person's ability to repay the loan and sustain any type of disaster. I think, interestingly enough, I was just pricing out a very large project the other day, and one of the lenders asked me, so what's their disaster recovery plan? So, the stronger someone's plan is in terms of being able to display their financial stability, I think that's much more important today than it was 6 months ago or a year ago.
And are you seeing this more in the commercial space? I know we talked about this a little bit on the pre-call.
Yeah, both ends. Residential, not only are we looking for larger reserve requirements, but we're also looking to validate cash flow through bank statements. So on a multifamily transaction, for example, on a residential and or commercial, we want to see that, okay, you're saying you get $20,000, net after taxes. Well, we want to see that going through your bank account.
Right.
And they're looking for a 3-month history of it, 6-month history of it. Whereas I think pre-pandemic, we didn't really have to worry about it.
Yeah, I know.
So
It's
that's something that is different. You know, they're looking into losses. Are the losses, you know, pandemic related? And, you know, was it a business that, like construction, for example, construction was shut down for 3 months. Construction was opened back up. So now if someone was, you know, looking to buy a building, perhaps an industrial space, warehouse type space, if you're in construction, what's your ability to be able to pay back that loan? You know, cost of supplies, even though you might be making a lot of money because everybody's, you know, fixing their backyard and making their pool pretty, the cost to do these renovations have quadrupled. You know, the cost of lumber,
Yes.
the cost of everything is quadrupled. So, you know, if that person buying this this industrial building or warehouse, is businesses based on today's numbers versus 12 months ago, how are they going to pay back the loan when the dust starts to settle?
Right, right. So let me ask you, you know, we talked about liquidity, and that's like the number one thing that you look for. Is this the same for domestic versus international buyers?
So far, I haven't seen a real difference in the look in terms of if it was a domestic person versus an international person, because, you know, bank statements don't lie. Someone has money, whether they live here or, you know, in another country, if they have the assets. But I haven't experienced anything different for an international person yet.
Oh. And is
So far.
that from the bank's perspective? You haven't experienced something
No.
different. Okay.
No.
How about from the private lending? Because I know you work with private lenders. I know I've gone to you guys to source you know,
More
private financing.
more reserves, escrow deposits. You know, are you willing to park X amount of money in a fund that you can't touch for a specific period of time? So I think it all boils down to cash on hand, and that's where
Right.
the debt versus equity is always going to come into play.
Right, right. So do you see, I guess, in the future now, I mean, none of us can predict, but do you see it easing up, the requirements easing up for
So
the resumes?
I'll just say this, you know, after 2010, we went through, you know, I don't know, I mean, I survived it. I conducted business through that time. And, you know, when we experienced the 2010 financial crunch, that's exactly what happened. Guidelines became stricter, reserve requirements became higher, loan to values were lowered. It was just harder to get credit. And
Right.
ultimately, it never really went back to 2007, nor should it have, obviously, because that was what the issue was, is just lending was just too flexible. But it did come back, and it came back sensible. So I think now with post-pandemic financing, I think it will come back. I think it's just caution. You know, it didn't help that, you know, entities were encouraged, investors were encouraged to not pay their mortgage, make their mortgage payments, not pay their mortgage. And, you know, and that lenders were forced to offer forbearance to, you know, mortgagees, and mortgagors were left to hold the bag.
Right.
So I think from that perspective, I think it will come back, and it will come back quicker than it did from 2010, but different. You know, I don't think liquidity is going to change quickly.
Okay.
in my opinion.
Okay. And how about the forbearance issue? You touched on that a little bit right now. Do you see that that's really helped people through this? Do you think there's going to be a, you know, on the commercial side? Because, you know, the commercial transactions have declined. You know, the residential market, there's a lot more stuff going on across the board in commercial. Everything's kind of taken a hit. And how much of that do you think is the forbearance that's happening right now? The businesses are able to stay afloat, or why is that happening?
So twofold is, there's two parts to the question. Number one, we're seeing a tremendous decline because we did go through a shutdown. Businesses were shut down. So again, you can't do commercial leasing, commercial financing, commercial lending when there is no business to base the
Right.
cash flow off of. And then again, now that things are opening up, in what capacity? You know, like New York City, still people aren't going back into their offices until September. I'm full capacity, but
Right.
you know, many offices in the city are just still exercising extreme caution. So until everything is open and functioning, commercial real estate isn't going to pick up because there's no cash flow support. The forbearance part of it just kind of it came upon, and it's created this huge hiccup for everybody, because now as a lender, if a person can and did just decide with government support that they're not going to make a mortgage payment, well, there was no aid to the lender to continue to pay the taxes and insurance and maintain that property.
Right.
So the hits that the investors and servicers took due to forbearance were tremendous. All the statistics are coming back, so it's not as bad as we thought it would have been or could have been, because many people did go back into repayment or have deferred the payments to the end and now are making payments. But for those companies that, or those people that, you know, couldn't sustain and they're just letting the properties go, now these servicers are holding these properties, and in New York, you can't even foreclose on them. So it's a very, very difficult position for servicers and lenders to be in when you're now holding properties that you have to maintain, and that the mortgagees aren't paying their mortgage, and there's no
nothing that can be done. Yeah.
I hope that answered that question.
No, it definitely did. And by the way, just to the audience, you know, now that we have this format, if you have any questions, please feel free to type them in the chat box. We are going to be doing the networking afterwards. I just see one, someone was asking, Zahra, your company name. It's Links Mortgage. They're out of New York, but I've worked with Links a lot, and they do loans nationally, so you don't have to be in New York.
So commercial, yeah, we do nationally. Residential is New York right now. Florida, Connecticut, New Jersey, and Texas are pending.
Right.
Maybe even California, for all you people out there in California. I'll throw that up.
So what do you see then for, you know, let's take hospitality, since I work in that space and I know that space so well. What do you see for the future of hospitality lending then? Do you think it's going to be the way it was before, or?
I think this is a human nature question. People aren't going to stop wanting to go on vacation.
Right.
People aren't going to stop wanting to go to conferences. And once it all boils down to once each city opens up completely, and each organization opens up completely and gets back to doing conferences and having the format that we were used to. And I think that will happen. I mean, I know a lot of people think that Zoom will be the new way of meeting. I think Zoom will supplement, but I don't think it's going to prevent the in-person events. I think it's just humans need
interaction,
and that's the natural way to interact, right? So, but it's a natural way to network. So once that all comes back, I think hospitality lending will come back completely. You know, just as an example, New York City, like all those hotels that did close down and were converted into different spaces, that demand will come back once the city reopens. You know, already, like I had my son's graduation last weekend. And 2 months ago, I was either going to go to an Airbnb or I was going to drive an hour to my ski house in Vermont. I was not going to stay in a hotel.
Right.
But then everybody got vaccinated, and
now you're okay with it.
And I stayed in a hotel, and it was great.
after a long time.
It was great. And so I think the mentality of humans and of people, they're not going to stop wanting to go on vacation.
Yeah.
So I think it will come back once all restaurants are open back to full capacity. I mean, I always laugh. It's the roaring 20s. I think we're going to experience a lot of roaring 20s activity. So
Yeah, I mean, we're already seeing it down in Florida since everything is open down here. We've got people coming down here in droves for vacation and relocating.
Yep.
So the commercial has to follow
It
all
will.
of the residential that's happening. So, you know, I'd like to help our realtors that are on here, some of the resi-commercial people as well. You know, what's the price point where it kind of switches over from a residential loan to a commercial loan? Because a lot of the people that some of our commercial brokers work with, you know, they're looking for smaller assets, their first time, you know, um, they're opening a restaurant or they're opening, you know, something local to pay the bills to help them, you know, buy a house, whatever it is. Where's the cutoff between a residential mortgage and a commercial mortgage?
So the cutoff is determined by unit. Okay.
Okay.
So residential mortgage is a 1 to 4 family home, co-op, or condominium. That is what's considered a residential loan. And the loan sizes for Fannie Freddie go from, you know, 50,000 all the way to 822,000 in New York. The loan limits differ per state and per county. And then once you go above 822 in New York, for example, then that becomes a jumbo loan. But if it was a single family dwelling, that would still be a residential loan. So
what happens if it's like a five unit, but it's under $1 million?
5 million is
that-
commercial.
It's considered a
Pardon
commercial
me, 5
loan.
unit is commercial.
No,
So
I
once
know
you
it is
go
on the real estate side, but it's still considered a commercial loan.
Correct. Once you're
Okay, even
over
if it's
4
okay.
units, that is considered commercial. So a
Commercial
6
loan.
family, 6 families commercial, 5 family, you know, 1 store and 2 apartments is commercial. That's a mixed use.
Right, right. No, I know from a
yeah.
real estate perspective. I was just wondering from a lending perspective, is there any difference? Or if it's a smaller restaurant or a smaller business, nail salon, whatever it is.
No loan size is too low for commercial.
Okay, okay.
If it's zoned, you know, and then you have to worry about zoning. You could have a single family
Right.
dwelling, but it's zoned in an industrial area and, you know, they store all their lumber there. That would be
Right.
a commercial loan, even though it's a
Right.
residential home, residential property. So it's unit based, completely unit based.
Okay, okay. Well, that's very helpful. So we are at about 5:30, and I wanted to open it up. Everyone is welcome to turn on their cameras now.
Thank you so much, Ritu, and thank you,
Thank
everybody.
you, Zahra, for joining us. If you're able to stay for the networking, we'd love you
I just
to
wanted everyone to
stay.
meet Dan. Dan is our analyst who likes to hide in the back.
Hi, Dan. It's nice to
So
see
he's
you.
the one that actually does, I just talk, he's the one that does all the work.
And I will attest, I've talked to Dan many times, and he's very responsive. So
Yeah.
if any
So
of
if you ever have any
need-
commercial needs, reach out
Yes,
to Dan.
Absolutely.
you know, they are ARIA members, and it's just it's a good resource to have if anyone has any questions. But you know, again, I welcome. Thank you so much, Zahra.
Thank you.